Well, good morning, everyone. My name is Esther Awuni, business anchor at CNBC Africa. It is my pleasure to welcome you all to this webinar hosted by Comercio Partners, an investment firm focused on trading in fixed income securities and equities. Now, the company also provides financial advisory and asset management services. Now, this webinar is part of the company's Knowledge Series 3. The theme for this webinar is a 2021 outlook for the market, money, and risk. Now, we have an exciting lineup of speakers and panelists who will be sharing valuable insights on the market and economy in 2021. Once again, on behalf of Comercio Partners, I welcome you all. Now, allow me to introduce you our guests and speakers for today's conversation, starting with the team from Comercio Partners. Please welcome Nnamdi Nwizu, co-managing partner and head of trading, Tosin Osunkoya, co-managing partner and head of investment, Steve Oshaw, co-managing partner, Comercio Partners Limited and managing director, Comercio Partners Capital Limited. And finally, please welcome Victor Aluyi, Head Portfolio Management, Comercio Partners Limited. Also joining us is Abiola Adekoya, Lead Wealth Advisor at RTOS Capital Limited. Abiola is a notable expert in the financial services sector. She's also a former MD, CEO of FBN Quest Securities and RMB Nigeria Stockbrokers, a subsidiary of the First Rand Group. Please also welcome Adin Relay, additional former commissioner of Budget and Planning, Ogun State. Relay has also spent 20 years in the private sector and has worked extensively in the financial markets within Nigeria and the UK. Now, allow me to especially welcome our keynote speaker for today, Dr. Doyin Salami. He's a chairman of the Presidential Economic Advisory Council. Well, thank you all for being here today. Now, we'd love for you to be a quick note to our participants now. Welcome all of you for joining us today for this webinar. So a quick note, we'd love for you to be part of today's conversation. So please use the Q&A feature at the bottom of your screen to ask questions. We're also going to be taking your questions today because we want it to be a robust conversation. We want everybody to have the chance to be a part of today's conversations. But also note that the chat function has been turned off, so you won't have access to that. But please use the Q&A feature at the bottom of your screen to ask your questions. You can also follow the conversation on Twitter with the hashtag CP Knowledge Series and hashtag Market Money Risk. Now, to kick things off, we're going to take opening remarks from Tosin Osunkoya, but before then, we'd like to quickly share some results of a poll that was taken by Comercio Partners, asking respondents about their thoughts on some key economic indicators. And we have the results out that we're going to be sharing right about now. We asked questions around inflation, basically the state of the economy, inflation, GDP, the fixed income market. One of the questions that was asked was a question about the yield environment, whether or not respondents think that the low yield environment is going to be sustained in 2021. If we could just have some of those results of the poll up on the screen for our participants to see. So here's an example on the screen. So we're going to have this up for about 5 minutes or so. So a couple of questions were asked, like I said, on the state of the economy, but more generally, the economic outlook for 2021. So I'm looking at one here that says, do you think that Nigeria's annual inflation rate could touch 20% by the end of the year? Now, that's quite a steep number, but we do know that inflation is over 14% already. And of course, we know that inflationary pressures still remain. So who knows? And it's definitely going to be one of our talking points today with our speakers who share more perspective on what they think or where they think inflation is headed this year. Now, another question that was asked is, what is your opinion, or what in your opinion are the indications of economic recession in Nigeria? Is it a regular decline in GDP? Is it a global effect on on crude oil prices? Is it raising government borrowings? Is it a slump in personal income? I think we've already seen a couple of that happening in the economy also, especially that slump in personal income and raising government borrowings. So yeah, we do have a couple of indicators in that respect, but it'd be interesting to see those results as they come in. I think we also asked the question on the low yield environment, as I mentioned earlier, whether or not investors think that the low yield environment is going to persist in 2021. Now, we know that the government has a big budget deficit this year for the 2021 budget, about just over 5 trillion. So obviously that means that the government is going to borrow more. And with that special bill that we saw at the fixed income market in 2020, where we saw a spike in fixed income yields. So I suppose that's sort of like an indication that we might see a yields trending upwards. But I don't want to preempt, I don't want to give too much away, as it were. I'm going to leave that to our speakers today to share more perspective, especially Abiola, who is going to give us a market perspective today. So yes, a couple of questions, and it's quite interesting just to get your thoughts on the state of the economy. Obviously, it's front and center these days, what with the pandemic, the COVID-19 pandemic. Now governments are having to borrow more. We're seeing debt levels rising. So that is a threat, especially on the revenue side of things. And for Nigeria, debt service also. So those are things to think about. And those are some of the talking points that we're going to have today. So perhaps if we could just have more of those questions that were asked to our respondents to get a broader view of the questions that were asked. Anyways, it's going to be up for about 5 minutes, and we're going to just see how or what respondents think about some of those questions that we asked. As I mentioned before, we have an interesting lineup of speakers. We have Dr. Doyin Salami, Chairman of the Presidential Economic Advisory Council. He'll be making a presentation on the state of the economy. He'll be sharing his thoughts. And of course, we'll be talking about, I'll be engaging him in some questions just to pick his brains on where he sees the economy going this year. What are the risks? What are the opportunities also? And not just risk, opportunities. That's why we're all here. We are going to learn both the risks, and we're also going to learn what the opportunities are, especially from a market perspective. So I'm thinking that perhaps we can just move on. If we do not have more questions from the poll, let's just move on. Okay, we have more. So there's one here which says, what is your opinion? What in your opinion? Okay, I've taken that. So the results are in. So for regular decline in GDP, 45% of respondents responded up 45. 34% think that global effect on crude oil prices is a good indicator of economic recession in Nigeria. 22% believe that raising government borrowings is equally important. 24% indicate a slump in personal income. So regular decline in GDP, and I suppose that's quite spot on. We have seen a decline in GDP growth. Remember, we're in a recession, and for the IMF has revised its GDP growth forecast for Nigeria down to 1.7% for 2021. But the federal government of Nigeria still believes that the economy is going to grow about 3% this year. So I guess we will see, and I'm also quite looking forward to Dr. Salami's presentation to hear his thoughts. He's also going to be talking about the economy, to share those risks, and of course to share his overall view on on the strength of the economy this year, and where he thinks, or how much growth or how big a growth we are going to see this year. Okay, I think at this point, let's just quickly move things along. Now, to kick things off, let's take opening remarks from Tosin Oshunkoya to kick things off for us. Tosin.
Thank you, Esther. Good morning, ladies and gentlemen. You're welcome to the third session of our annual knowledge series. In line with our strategic intent and philosophy at Commercial Partners, we believe we owe our esteemed and prospective clients, our partners, our other capital market operators, and every other stakeholders in the global financial market this responsibility to provide a platform for insightful interactive session and knowledge exchange. So once again, good morning and you're welcome. You will all agree with me that the theme for this year, 2021 Economic Outlook, the market, the money, and the risk is certainly right in this moment. I remember the Latin phrase, omne traum perfectum, which means in English, everything comes in three is perfect. Everything that comes in three is perfect. We strongly believe that these three powerful elements would shape our perspectives and degree of success as we proceed into 2021. First off, let's start with the market. Without a doubt, we operate in an extremely volatile, uncertain, and complex market. As, as the COVID pandemic, the US election, the general major trends in the global and local economies have shown us and demonstrated that there's so much uncertainty in the market. The market to us is an ecosystem that we all operate in. Therefore, our existence in this market can only be driven by the fact that you must have sound knowledge and you must always have professionals that can help you to navigate, the moving parts in this market. Otherwise, you will find yourself in a big situation. Then the money. In spite of the doom and gloom and the pandemic and the second wave, we believe that we can still spot opportunities in this market. Therefore, you would need the professionals, all right, to come together to help you in unpacking and help you in exploring these opportunities moving into 2021. The risk. The risk is the elephant in the room. A lot of us, many years, in various fields, we've been dimensioning and, of course, managing risk, be it the market risk, the price risk, liquidity risk, currency risk. But we're stunned in 2020 with the pandemic risk. The pandemic risk has crystallized and it has crippled many businesses. It has crippled many economies in many countries. We believe that as we move into 2021, it's important for us to dimension, this risk amidst the other risks that we are known with. Going into this year, at Commercial Partners, in line with our mantra, we believe that as we lead you into the future, it's important for us to assemble an array of respected speakers that will come together with you to help you in this interactive session and help you in navigating this terrain such that you can be well equipped and empowered and know exactly what to expect. I believe that as we move into this 2021, it's important also that safety is something that we must take to heart. We must be safety conscious, not just in terms of corporate entities, but even your staff as well. As we go into the session, I pray that we have an interactive and insightful session. Thank you.
Thank you very much, Tosin. You hit the nail on the head. Of course, it's very important to have the right kind of knowledge to navigate this new environment that we've found ourselves in. I'm talking about this economy and the market in a pandemic, and of course, knowing how to navigate, having the right information to navigate that space. Thank you very much, Tosin. Now, let's move things along. Next is a presentation by our keynote speaker. Please welcome Dr. Doyin Salami. Dr. Salami is the MD CEO of Kainos Edge Consulting and also the chairman of the Presidential Economic Advisory Council. A renowned economist, he's also a two-term member of the Monetary Policy Committee of the Central Bank of Nigeria, and he's also equally served on IMF's Advisory Committee on Sub-Saharan Africa. Dr. Salami, thank you so much for being here today. It's a pleasure to have you. Over to you.
Yeah, very good morning to you. And good morning, and thank you very much for the invitation to participate in your session this morning. And I hope we have a good session. Right, am I enabled to share my screen?
Yes, I believe so. Please go ahead.
Let me see if I can do that. Right, I assume you can see my screen now. Am I good to assume you can see my screen?
Yes, I
All
can see
right.
your screen. I believe everyone else can. Please go ahead, sir.
Right, thank you. Um, so I'm going to essentially speak over the next perhaps 15, 20 minutes about the macro. I know the theme of this session is the market, the money, and the risk. But then I crave the indulgence of the audience. I am not, in terms of the market, I am at best a peripheral observer and a sometime user. I'm an economist, and so I will speak from the perspective of an economist taking a macro look at this economy of ours and what the issues are, what the opportunities are, what the challenges might be in 2021. I will then leave it to other esteemed members of this panel to relate these to money and to money markets and the risks. So it's usually for me three questions that one needs to answer. The first, of course, is to understand what are those things that drive the economy here in Nigeria
Sorry, guys, we're
and
not speaking. Let's remove our cameras. So don't disturb.
appreciate where we are vis-a-vis the current state of the economy, and then to try and understand what it is that are likely to be drivers in 2021 and some sense of where we finish up or what might be the outcomes before then looking at what opportunities perhaps might be available and what risks might also be needing to be taken care of. And so in terms of, the drivers of the economy, my own reflection over probably 2, 3 decades says to me that the economy in Nigeria is affected by domestic policy, but it's also significantly impacted by global conditions. And there are four dimensions to the global conditions that we have identified there: international policy, international trade, capital flows, and diaspora transfers. I'm sure there are a couple of other things, but these, in my own reflections, are the four key things that I usually will pay attention to in an analysis. 2020, however, brought to the fore something else that we hadn't and is not yet included in my analysis of global conditions, which is the interlinkages outside of the economy. In other words, 2020 showed us through the COVID pandemic that a health challenge somewhere far-flung part of the world even could become a global challenge. And that is what the pandemic has become. What started as a health challenge has effectively hobbled health systems around the world. The disruptions occasioned by trying to manage using lockdowns and various kinds of restrictions have then now become a real challenge for economic activity. And in some countries, the health challenge, which morphed into an economic challenge, now has humanitarian and in some cases security dimensions that they're having to deal with. And so this for me is essentially the external environment that we have to look at. Let me preempt myself by saying 2020 was a very tough international environment, not just for Nigeria. And the projections so far for 2021 suggest a sharp turnaround, a sharp positive turnaround in international conditions, which may well augur well for the economy in Nigeria. Now, if we take a quick look at this global context, as I've said, 2021, it's largely about COVID-19. And I would suggest that still 2020 was largely about COVID-19. And I think for 2021, notwithstanding the arrival now of vaccines in various parts of the world, I think COVID-19 is still likely to be a major issue in 2021. As I'm sure this distinguished audience knows, across large swathes of Europe, Asia, there continue to be lockdowns. And that, of course, continues to disrupt global economic activity. It will be interesting to see what the numbers for Q1 are when eventually these are published, probably around about between April and perhaps June. But what's clear is that notwithstanding the arrival of vaccines, we are seeing in many countries new spikes, new peaks, even though it appears that in some of the major countries, these peaks are now beginning to come under control as vaccines are being applied. Having said that, I think the key drivers and risks for 2021 would really be, as I've said, COVID-19. To what extent is the rollout of vaccination successful? And to what extent does that then help to manage the pandemic? As I keep monitoring international media, you get the sense that in many of the key countries, they are working towards herd immunity, which is unlikely to be attained until about 70% of their populations are inoculated. And that therefore suggests that that is not anything that is going to happen very quickly, probably in the second half of the year if things go very well. A new US administration, and so what the impact of its policies are going to be. And for Nigeria, I think a key one is going to be the US's stance vis-a-vis Iran, because that then will have an impact on international oil markets. As I will show later on, international futures markets project oil should be stable in a range, an average range around about $54, $55. And so energy, global commodity markets are going to be important. And as I said, well, the prices look like being more stable in the course of this year. As this shows, unlike what we had seen in 2020, the outlook for the global environment is much more optimistic in 2021. I dare say that by the end of Q1, we will see whether or not this optimism there's any reason to revise this optimism. As for Nigeria, we will come and discuss that in a short while. As far as Nigeria is concerned, well, we've said it, it's been said time and again, yes, an economy recovering from COVID, from a prior recession. But even at then, it was still trying to deal with a whole series of structural issues that had existed before then. But then we, as with many countries, found ourselves or entered into a recession, not found ourselves, but entered into a recession in 2020. And the last set of figures we have seen ending in Q3 2020 seem to suggest that perhaps the trough of that recession has been negotiated, because if you remember, minus 6.1% was the decline in quarter two, and by quarter three, that had improved to slightly around about minus 3.4%. And so, we hope that by the time we see quarter four numbers, we see an improvement. I suppose the key challenge is that combination of rising prices and contracting output. That is really what is going to prove to be a source for significant reflection and some policy dimensioning that will require policymakers to reflect deeply about how we get rapid and sustainable growth going forward. But we'll come back to that in a minute. We need to come back into a position where we have macroeconomic stability. We've departed from that. as this shows, our sweet spot was about 2013, 2014. The key challenge as far as the output sector is concerned is when you look at the 6 biggest sectors in the economy, agri, even though it's growing, was growing at about 1.4%, which is significantly below population growth. Other sectors, I think beyond agri, only the telecom sector out of the big 6 grew at least in the first 3 quarters of 2020. Pretty much every other sector, every other one of the big 6, so contracted in 2020 in the first 9 months. Oil and gas by almost 6%. Now, the other key issue, as I'd raised earlier, is rising costs. Please, we have to bear in mind the adverse impact of costs on 2 levels. First, in terms of households, costs undermine the purchasing power of households and therefore makes life difficult on the demand side for corporates. But the other challenge that costs raise directly for corporates is that as inflation rises, their own competitive capacity diminishes, because it means that their own costs are rising, and therefore their ability to defend their market share, especially in relation to external producers, may come in for a challenge. And so one of the things that I expect to see in the course of 2021 is a greater focus on managing inflation downwards. At almost 16%, with food at almost 20%, I think the time for facing inflation squarely is, I would argue, with us. Of course, the challenge around unemployment is fairly well known, but we need to grow the economy in order to get that. Unemployment is a lagging indicator of economic performance. On the fiscal side, the challenges remain, and we are going to have to think very carefully about how to do what. Because I think the moderator in her comments had alluded to the size of the deficit and the need to borrow. I will, as I go along, perhaps suggest that there are a couple of things that need to be done on the fiscal side. Not least is an assessment, an ongoing assessment of the effectiveness of government spending. In some areas, money is being spent very significantly. And I think it'd be useful now as a nation, not just at the federal level, but at all levels, to answer questions such as how is the budget doing, or budget performance questions, not by saying how much we have spent, but by tying it to the outcomes that have been achieved with regard to the spending that has been made. It's a challenge that I think we would need to really face in the course of the year ahead. All of this simply dimensions the stock, the nature of the fiscal challenge that Nigeria is working its way through at the moment. Well, the external account is also, it's also an area where attention will need to be paid. We've got a weak external account. It doesn't matter how you look at it, whether it's in terms of trade deficits, whether it's in terms of capital flows. And a major element of our external imbalance, which I think, again, we need to start taking a look at how we approach this, is that I'm of the view that it's now important for Nigeria to attract international and domestic investment, to mobilize very aggressively domestic and international capital for investment. If we are going to grow meaningfully, it's only one thing: investment, and more investment. And if we are going to get investment, then a whole host of things become important, not least is macroeconomic stability, but I will discuss that shortly. But one of the key areas that I think we also need to keep an eye out is the whole area of exchange rate differentials, because I have read in certain publications how it is insignificant, what monies are used on the from non-official sources. If you look at official data, in 2019, the full year, $30 billion, in other words, almost 1/3 of total outflows were obtained from sources outside the CBN. In the first half of 2020, almost the same run rate, because you've got almost $14.8 billion, 42% of total outflows came from non-official sources. And the challenge that this certainly poses is going to be a challenge for ensuring that we can get harmony in the exchange rate markets. What's going to drive 2021? A number of things are going to be very important. As I said earlier, global recovery prospects currently, both the World Bank and the IMF take a view that it's going to be positive, unlike the contraction that we had seen in 2021. Forgive me, that should be global recovery prospects in 2021, not 2020. Oil prices are going to be very important, simply because for Nigeria, that's a key provider of Forex. Indeed, when you look at the numbers for 2020, notwithstanding the fall in oil prices at various points, oil still was roughly 80% of our revenue, of our external revenue profile. And then the third thing for me is going to be our ability to stimulate investment. Currently, investment is sub 20%, and yet, in my view, we need to take investment consistently above 25%, in a range that is somewhere between 25 and 30% is where I think we need to catch investment for Nigeria's economy to grow significantly. Don't forget, this is an economy whose population is projected to grow to 400 million. Now, in terms of what the outlook might be, I don't do any of these forecasts. As an economist, I have learned some very bitter lessons trying to forecast. But what is clear from the various forecast sources is that, yes, there will be positive, we will return to positive growth. How soon, we will have to wait and see. But it looks like we will return to positive growth in the course of 2021. With the government's forecast as contained in the budget document being at about 3%. I expect that inflation should receive attention in the year ahead and therefore expect it to ease. But the real challenge is, how do we stimulate investment? In my view, we need domestic and international investment in key sectors: agri, energy, manufacturing, healthcare, infrastructure, technology. And if we're going to get that, a whole series of things need to stack up, not least the internal coherence and consistency of fiscal, monetary, and regulatory policy. And so what do I see if we're going to get investment? A number of things. First of all, we need to ensure macroeconomic stability. Secondly, as I said a moment ago, consistency in key prices. We need to resolve that disparity between interest rate, in other words, yields, and inflation. We need a foreign exchange management policy that stimulates output growth and promotes investment. It's also, in my view, very important that Nigeria looks at a policy of multiple growth poles across the nation. In other words, we need to create growth hubs in each of the regions. And that does a number of things. One, it makes for more balanced growth across the country. Secondly, it also makes for a reduction in the inter-ethnic migration that we're seeing. If you look at the poverty numbers for Nigeria, the average is 40.1, but the range is between 4.5 in Lagos and 87% in some of the northern states. And so you can imagine, if we're able to create growth poles around various economic resource mappings, then you would, as I said, have a growth configuration that is more balanced and allows the entire nation to develop in tandem. As I already said earlier, it's going to be very important to switch to looking at the effectiveness and efficiency of government spending, because it's not as if the government is not spending money. In this 2021 budget, government's raised its projection of expenditure to over 13 trillion, even though it does expect a slight reduction in its revenue. But the key question then has got to be this increase in expenditure. How do we ensure that it does produce the kind of economic stimulus and economic growth, inclusive economic growth that we really have got to, achieve? It's also going to be important to protect the vulnerable. The government now has a social investment program, and which of course supports the bottom of the pyramid. Now, how do we ensure that this again is an important and sustained and sustainable investment program? Because again, without that, the point about inclusiveness of growth will simply be very difficult to achieve. And then, of course, and for me, the other key thing is going to be how do we address the challenge around youth unemployment? Having said earlier that unemployment is a lagging indicator of economic conditions, I think we're clear from the available data that the challenge around youth unemployment is one that needs to be met as quickly as possible. And so, in my view, certain interventions, especially in terms of vocational education, but also, again, in light of my earlier comments about creating growth hubs, the need to identify industrial interventions capable of absorbing the large numbers of the unemployed, I think, is now a very, very important dimension. That is of strengthening the agri and industry linkages that we really need to make our economy grow meaningfully and sustainably. And so for me, if in summarizing, I'm pretty clear that a couple of things. At the end of the day, 2020 will be better than 2021, my apologies, will be better than 2020. We expect to see economic growth in 2021. I expect that the policy authorities will pay more attention to inflation in 2021, and therefore we should see lower inflation. How much lower we will see as time goes on. I expect that the policy environment will also include, continuing reforms. We saw some reform in the energy sector in 2020. I'm hoping, and I can see a scenario where the government continues to deepen and strengthen those reforms so as to stimulate investments into the various sectors that need to be. So I think overall, it's a cautious optimism. Please don't get me wrong. I'm one of those who is clear in my view that growth has got to exceed population growth. And don't forget, population growth is in the range of 2.6 to 3.2%. And so any growth that is lower than that, and currently, with the exception of the government's projection, most projections of growth for Nigeria in 2021 are sub 2%. However, there are projections, and I think the NESG, the Economic Summit Group, has published some projections which show that Nigeria could actually get to a situation where we get to about 3% this year, but it cannot be on the basis of business as usual. It's got to be on the basis of a reform mindset that allows us to stimulate significant local and international investment as a way to drive the economy meaningfully and reduce unemployment. So, ladies and gentlemen, that's my view of the macro. Now, in terms of where the opportunities are, I'm very clear that, well, let me deal with the risks first. I think the key risks are actually more policy risks than they are anything else. If policy is internally coherent and consistent and takes care of some of the dissonances, some of the disruptive influences that it has, then we should be fine. If it doesn't, now that poses a serious challenge that we would all have to think about. But in terms of the opportunities, I think COVID has already thrown up quite a number of things. Now, there are some opportunities that came up in 2020, essentially as a result of some of the disparities we saw, especially in interest rate yields, and which is why we also the stock market become, I think it was the best performing stock market in the world. I am hoping that that gap between inflation and interest rates or yields is significantly closed, if not completely eliminated. And so there would have to be, in that case, there would have to be new opportunities to be found. And I think certainly there are asset classes that are growing, especially commodity asset classes, that are going to be an interesting proposition as far as 2021 is concerned. Outside, still in the markets, I think, and the issue around foreign currency exposures are also going to be a dominant one in 2021. My expectation is that the appropriate authorities will work, as I had recommended earlier, towards a foreign exchange policy that stimulates output growth and promotes investment. But I think for me, the biggest potential opportunities are across some of the sectors, provided again incentives are in place. So take, for example, I had said earlier that agriculture is growing at 1.4%, but it needs to grow faster than population. Two areas, and I call them, or I place them broadly under what I call the farm to market strategy, where if you think about it, only 2%, Nigeria currently does about just short of 200 million metric tons of food. Now, 2% of our arable land is irrigated. So you can imagine a spurt of investment in irrigation would now give us the ability to reduce the uncertainties that arise as a result of seasonal rain-fed agriculture. A second area where I think in agriculture especially that would be helpful to incentivize investment is in the area of storage. In the figures that have been put forward for post-harvest losses in Nigeria range from 40 to 60% depending on crop type. And in my view, if we were able to incentivize storage, investment in storage, then that changes the whole dynamics, even if we don't grow a single additional metric ton of food. Imagine as follows. The South Africans have storage capacity, which is about 114% of what they actually produce. The United States has, I think it's about 78% storage capacity in terms of what it produces. Nigeria has less than half of 1% storage capacity for what we produce. So you can see there are so many opportunities in agriculture. If we look at energy, the challenges around electricity, in my view, call for policy reflection so that we can open up again even that space, bearing in mind that there are vulnerable elements, portions of our population that must be protected as we aim to reform some of these things. So in my view, I can see quite a whole raft of areas, whether it's healthcare, whether it's technology, there's a whole raft of areas that are calling for and ready for investment, but they do require overall government a consistent regulatory approach that enables investors to feel safe in making investments in the Nigerian economy. So all in all, I think we are going to see growth. It looks like it's going to be slow, but this year also affords us the opportunity to lay a foundation for subsequent rapid growth of the economy in Nigeria. Ladies and gentlemen, thank you very much for the invitation to this session. And if there are any questions or comments, I am happy to reflect on them and see what we do. Thank you.
Dr. Salami, thank you so much for that presentation. Very insightful, and you did highlight some very key points. And one key takeaway for me will be the fact that we need to begin to quickly mobilize foreign direct investment. We need to get those much needed investments in. It's going to be challenging with COVID. With COVID-19 pandemic still raging, but of course, we'll see how that plays out. At this point, we're going to go into a Q&A session. I'll take on Dr. Salami. At the same time, I'm going to bring in Relay and Abiola to give us a market perspective. And then we'll also, I see some of your questions, and just a thank you to our participants who are sending in questions. We'll try and take as many questions as we can. I see a couple for Dr. Salami. So let's see, we have about 15 minutes or so. So Dr. Salami, let me start with a question from me. Now, the COVID-19 pandemic has forced the federal government, or appears to have forced the federal government to take some hard but necessary decisions that have been delayed for quite a long time. Examples would be the removal of the fuel subsidy, the passage of the Finance Bill 2020, the devaluation of the Naira, the official rate to more realistic levels, and a willingness now on the part of the National Assembly to pass the petroleum industry bill. Now, to what extent do these drive confidence as we embark on an economic recovery?
Well, it's interesting you say that it's COVID that has forced the hand of the government. Well, I will leave you to your own view on that matter. What I think is important is to note, and which is what the point I made earlier, that the government has started making reforms. Yes, the process of reformation is not going to be short, sharp, and sweet. No, it's gradual and it takes time. And so I'm happy that at least there's some recognition of some of the change that is going on. But these changes need to deepen and sustain. And I think you've mentioned a couple that I think are very, very important. The petroleum industry bill, I think we need to, I am happy that we have read in the media some assurances credited to the leadership of the National Assembly that the PIB should be ready. I'm not sure whether it's the first quarter of this year or the first half of this year, but whatever is the time duration, at least there is a commitment to ensuring that the PIB passes. And because for me, a PIB would be a totem pole. If it's good and it's able to deliver on the investment opportunities. Let me give you the facts as, at least I have seen them. I'm not an oil person, but at least I've had some access to data. And I was surprised, earlier at the end of last year, when I listened to a presentation wherein we were told that Guyana, with 7 billion barrels of crude oil, between 2015 and 2019, attracted $49 billion of investment, I think. Nigeria, with 57 billion barrels, only attracted $3.5 billion. And so you can just imagine if FDI of $40 billion were to hit Nigeria's oil industry over a 5-year period, then you can imagine the implications for investments, for jobs, for foreign exchange. And you can also then imagine how that would free up the electricity side, because then there would be investment in gas instead of stranded gas resources and all of that. So for me, these are very important. And what I am sure the government is working on is to deepen and strengthen these investment drivers, going forward.
Okay, let me bring in Relay here to share her own perspective. Now, Relay, it's been said that until the Nigerian government significantly raises or increases the size of its annual budget, it will continue to fall short of its obligations to build an economy that will reduce economic inequality, poverty, unemployment levels, etc. But we know that the government cannot do it alone. We know that now with the COVID-19 pandemic and with pre-existing economic conditions before the pandemic hit, as Dr. Salami put it in his presentation, there are more constraints now for the government, even though the government is going to borrow more. But my question is, why is the government still having trouble adequately incentivizing the private sector to increase participation, particularly in key infrastructure projects that can actually make a difference? Really, did you hear me?
Sorry, I was still muted. Can
Did
you hear me
hear
now?
Yes, I can hear you.
Yes, I said thank you. Thanks for the invite. Thanks for the question. I'm going to go back a little bit because I think that you kind of touched on many things. First of all, the issue of the budget. We especially in the private sector, we have an almost obsessive focus on the federal budget, and we have no real lens on what is happening at the subnational level. Many of the things that we are looking to see the needle be moved on will only be effective if there is sufficient cohesion between the federal and the state government and those two processes of budgeting. So I think that that's something, first of all, that needs to be addressed. This issue of, the federal government simply increasing the size of the budget in a context of very ineffective spending. And I believe that Dr. Salami touched on that. It's something that needs to be intentionally reviewed. It really doesn't have, very much, impact. In terms of, driving private sector participation in the economy, again, it's without there being some levels of assurance in terms of reasonable policy stability. We've seen in the last few years a lot of very aggressive and knee-jerk and sudden changes in position across many aspects of policy that are enough to give people pause and give people concern. If you bring money in, you can't get it out, and then things change dramatically in terms of the prospects of the industry that you're invested in, and you lose significant value. You're not likely to want to rush back in. My view on investment, because we talk a lot about FDI, and I think FDI is important, but even from a portfolio point of view, if we even get to FDI, what the domestic mobilizers of capital are doing is an important indicator. And if we are not able to appeal to those who are in this context, that have money in this environment, that don't necessarily intend to move money to another one, and yet they are still very reluctant to participate and to deploy capital, then it suggests that we need to address that in the first instance, so that when a foreign investor is looking at the market, they can see some vibrancy among the domestic, stakeholders, and then what you're looking for from a foreigner is perhaps greater scale of investment or greater sort of levels of expertise, but not just seeing the domestic participants on the sidelines, arms folded, and expecting that we're going to have a swathe of foreign capital come in to build up the economy. And then see, typically what happens is in those instances, we as Nigerians become somewhat offended when it feels like those investors have a hit and run approach. They are very concerned about being able to leave whenever they need to, or when things change. But what do we expect if the domestic investor base does not have enough confidence to put their chips on the table? Then anyone who's foreign is more likely to be coming in on an opportunistic basis, or a much more cautious basis than the kind of long-term view that we really need to move the needle in terms of the dynamics of the economy.
Thank you very much, really, for that. Let me quickly bring in Biola here for a market perspective. Biola, now we know that the government is going to borrow more this year, and we're expecting borrowing at the domestic market. We're expecting yield. We're already seeing a slight spike in the yield environment. Talk to us what we should expect this year from the fixed income market. And do you see the CBN prioritize, while we're on the subject of foreign FPIs, do you see the CBN prioritizing foreign portfolio inflows to the extent that it starts adjusting its policy moves in their favor?
I'm not quite certain that we're going to see an environment where the CBN is going to. It's not a decision that can be made in isolation. I think, as Dr. Salami said, these are some of the things that need to happen for us to see the economy, for us to see any economic stimulation. So it's very unclear to say, oh well, we think that they would likely, move rates upwards. But if that were to happen, I think definitely, we would see more participation, I would say, by opportunistic foreign investment. And the reason why I say opportunistic is because I think largely the long-only funds who would typically, be excited about the Nigerian market sort of feel, have had their hands burnt in the last 18 months. And so would be very reluctant to, trip back in just because yields are higher. So I think we'll probably see if, more opportunistic, short-term focused foreign investors come into the market. I think that's really what we should expect if, the CBN were to increase rates significantly in 2021.
Okay, Dr. Salami, I want us to quickly just take one or two. We have quite a number of questions coming in, but I want just to have so that our participants can be a part of this conversation. There's a question here that I'm wondering if you can answer for us. This is coming from Esosa John Eha Gweri, and he's asking, or he or she is asking, how do you resolve the distortions between interest rates, yields, and inflation without altering the economy's delicate balance?
Well, you've got to be very clear what it is that you're trying to achieve. And don't forget, one of the things I have stated, and I dare say I have said this elsewhere as well, is that macroeconomic balance, macroeconomic stability is at the heart of any, let me repeat, any growth that is going to be sustained. And what is macroeconomic stability? Typically, what you'd like is growing GDP, and that's GDP growing faster than the population. You'd like falling inflation, and you'd also like an external balance. You'd like your external account, at the very worst, to be in balance, but preferably a tidy little surplus. And so if we are going to generate all of this, then there are signals that we must send that show to the rest of the world that, yes, we are headed in that direction. And one of them has got to be, you cannot sustain a situation, well, you can, but you shouldn't sustain a situation where inflation exceeds interest yields. And if you're going to close it, you're going to close it in a number of potential ways. You can either close it by bringing inflation down, or taking yields up, or, as is more likely to be the case, both, because don't forget, monetary policy is pretty clear. If you tighten monetary policy, then yields will go up. And so that gap will close. And so for me, it's a matter of what is the focus of policy. In my view, there was a study which a colleague and I at the business school had done many years ago, where we looked at what is called the inflation threshold for Nigeria. Now, what is the inflation threshold? That is the level beyond which, if inflation rises, it actually reduces growth. And that figure is somewhere around about 10, 12%. And so with inflation currently just a whisker of 16%, then we have significantly exceeded the threshold. And therefore, we are paying in growth for keeping inflation where it is. There are all sorts of things that you need to look at. If you take a look at money supply stock, M3 is growing at, I think it's about either 21 or 31%. That's far too rapid, especially for an economy in recession. I have to check that particular figure, but the growth in M3 is rather rapid. And so these are, so for me, it's about monetary, it's about macro stability and nothing else. Macro stability first. Upon that foundation, can you then build any number of other outcomes that you want?
Thank you, Dr. Salami. Let me quickly just take a second one. This one is from Adewumi, and he or she is asking, how can the African Continental Free Trade Area speed up economic recovery for Nigeria? Really, can you answer that question for us? I think that's quite interesting. We now have the African Continental Free Trade Area. We know that, I mean, we're creating the biggest market in the world for now, and we know that there are opportunities, especially boosting intra-African trade on the continent. So what are your thoughts?
Could Could you just repeat the initial part of the question, please?
So it says, how can the Africa Continental Free Trade Area Agreement help Nigeria boost economic growth?
Right. Well, I mean, having free trade is great, but you have to have reasonable levels of efficiency and productivity to sort of meaningfully partake in that. So, one thing that I feel that, having a sort of deeper perspective of policy and government operations is that, we tend to look at the economy in segments, especially in fora like this, where we're thinking about opportunities. And those opportunities tend to be short term, if we're honest. How do we get from January to December and come out positive? But in reality, without taking I feel the time for us to avoid the longer term view and looking at the sort of deeper seated issues, and for various stakeholders within this economy to coalesce around some fundamental issues is past. We have to engage with the realities. So having a freer sort of environment for trade within the continent is a good thing, and perhaps it will incentivize some of the policy interventions that are necessary. But I think one thing that is important is that there's an underestimation of capacity to actually do the things that need to be done. We're all looking at government to wave some magic wand, but there are many complexities that impede that. It's not just about having individuals with intellectual capital sitting around the table. It's a whole machinery that needs to move. And I feel that stakeholders across the board need to be more engaged. We need to ask more questions. We need to offer more support, offer more views, offer more input into processes that give rise to policy positions that will help us. Many a time, I feel that there's a remaining on the sidelines. And then, trying to scramble, after the fact to survive. Having an agreement is great, but if you don't have anything to trade because production is low or grossly inefficient, then I feel that it's a very little real consequence.
Well, thank you very much, Elaine. Abiola, let me bring you in. Now, we know that the government is going to borrow more. For the debt management office, borrowing is on both sides, and both foreign and domestic. Now, on the foreign side, let's talk about foreign borrowing. But first, I would like you to, first of all, give us an assessment of the performance of Nigeria's Eurobond yield since perhaps the outbreak of the pandemic in 2020, and also compared to other countries.
I think at the time, the yields definitely declined early mid last year, and with that they spiked, and with that spike, there was a lot of disinterest by a lot of investors regarding buying Nigerian bonds. But we subsequently saw that later on in the year, as yields dropped, there was a bit more interest, and I think overall there's going to be a bit more interest. Essentially in Nigerian Eurobonds, particularly as more investors look for better returns given the low interest rate climate that we're in currently. So I think definitely it would be if there was to be another Eurobond, we probably will see more participation by by investors across the board, both local and both international investors. I think we'll definitely see more participation there.
All right, thank you. Dr. Salami, there's a question. I would like to hear your opinion on this. Now, I've heard the UN Secretary General, Mr. Antonio Guterres, saying that the recovery from the COVID-19 pandemic must lead to a different economy for everyone. He's referring to countries now across the globe. What does that, or what do you share that sentiment, first of all, and what would that look like in the Nigerian context? I know there are a lot of moving parts for us. You've talked about policy issues, the challenges on both the fiscal and the monetary side. But for you, when you hear that kind of statement, what comes to mind for you?
Well, what comes to mind for me is a statement, I suppose, anchored in hope. Because we need to be very realistic. I think it was Denrile who was saying, there are so many moving parts that need to align, and exactly the same here. If you want a more globally inclusive economic environment, then the first challenge that you would actually have is, how do we get everybody out of the pandemic at roughly the same time? Now, you and I know that that is not going to happen very quickly. The major international powers already are struggling at their own ends, with the rollout of vaccines to contain the pandemic. Yes, there is some looking towards Africa and other emerging markets to say there should be some access to vaccines, but it's going to be interesting to see how the pace of access to vaccines, because look, one of the things that you can see as a scenario is where the international powers are able to vaccinate their populations and we struggle, and at which point access to these international markets for travel becomes limited, because then you'd have to carry a passport that attests to your having been vaccinated, in which case those who can will travel abroad to go and get vaccinated. And so what you can see is actually a prospect for a more uneven. If you take a look, currently, because of lockdowns and disruptions, education is bearing the brunt of it. Schools are closed in many countries. Homeschooling, internet, online schools is now what it is. Now, you just ask yourself, in Nigeria, how many of the population of school children, how many of them will have access to online capacity to continue their education? Once schools are shut, that's it. And so, and that's why I say, well, this pandemic has come and it has highlighted a number of disparities and areas of difficulty vis-a-vis the global economy. What would be useful is a greater intensification, not just of identifying where the challenges are, but of finding solutions to these challenges. Because if we don't, then the statement by His Excellency, the United Nations Secretary General, will, as I suggested at the top of my response, be anchored in hope rather than in any realistic capacity.
Okay. Now, really, the pandemic, as you know, has severely increased debt risks in developing countries. Nigeria is one of them, and current debt service levels and weak revenue mobilization prospects do not provide any comfort at all. You know that our deficit this year is just over 5 trillion. We have a revenue projection of 13 trillion. How do you see the fiscal authorities addressing this issue in 2021?
Well, there isn't really a magic wand, but, I think that, Dr. Salami alluded to the sort of prospects for the oil sector and, what that may translate to for, for government revenues, which is a potential source of relief. I think also, we have seen a forced efficiency in some respects on account of the pandemic. There was in the recent past, if you had expected even large parts of public sector to operating remotely and functioning in the way that they have done during 2020, it would have been deemed impossible. So I think that perhaps on the contraction of spending, there's probably some light that light bulbs that have come on during the course of 2020 that will help. I think that the prospect of a firmer oil price, is also something that will help. But again, typically there are no silver bullets and there are no short-term remedies. The reality is that we are in a relatively weak position, and many things need to come together at once in order for there to be meaningful relief. I think that as an economy, and even just as a culture, as a psychology, I feel that, we're not so inclined towards high levels of efficiency or productivity. And it's something that needs to change. And I think that the events of the last 12 months have begun to force that. So it's going to take strengthening of our revenues, yes. It's going to take better deployment of the revenues that we have. It's going to take greater efficiency in our operations that us operate, at lower cost. And these things need to come together in meaningful enough ways to translate into relief. But even that, it's not about, 2020 was tough, 2021 or 2022 will see us resume some sort of normality. There are actually meaningful things that need to be shifted in order to sustain an improved position. Otherwise, at rates of debt servicing being 83% of revenues, it doesn't take a genius to work out that we are in a precarious position. And I think notions of a silver bullet should be, aside from oil going to $100, which I think we can all agree is not going to happen. There really isn't one. It's about adopting appropriate positions and sustaining those positions for long enough across a variety of variables to see it translate into a stronger position over the medium term.
Well, thank you very much. We're just going to end this session in about 3 minutes. So I'll just take one more question from response from Abiola. This is coming from one of our participants, and he says that why is the government still having difficulty harmonizing the FX rate?
Well, why is the government having difficulty?
I know that is always a tricky one.
It's always a tricky one. I think the question, I quite understand the person's concern as to why the government is having a challenge with it. And, it's been ongoing for, would I say, the last 18 months. We've seen this happen before in 2015, where, it took almost 18 to 24 months before, we did see a convergence between the rates. Will there likely be a convergence between the rates? It's unlikely that we're going to see it. I wish I had a crystal ball to tell you, when the convergence would likely happen. But I think to a large extent, I think the government is really the CBN is just focused on, ensuring some sort of stability across various areas. So they're trying to manage inflation. They're trying to manage, money supply, and they're also trying to manage FX. I think that's a very precarious position for them to be in. And I think the reality is that one of those things need to happen, right? We either need to, would I say, have some sort of shift in the managed exchange rate, or see some sort of uptick in interest rates for there to for us to find some balance. But would it likely happen soon? I'm not quite sure. I think Dr. Salami may be in a better position to help us answer when that convergence and when that shift may happen. But I think that in terms of interest rate, in terms of the currency, I think we'll probably continue to be this way for, I guess, another couple of months. I don't see that that would change anytime soon. I think that to the extent that our reserves remain what they are, I don't see there to be any change. You should expect soon.
Thank you very much, Abiola. We're going to, with that, close this session. Thank you so much to all our speakers, Relay, Dr. Salami, and of course, Abiola. Abiola, you are going to stick around, so we're going to have to release Dr. Salami at this point. Thank you so much, Dr. Salami, for being here with us and sharing that very insightful presentation. So at this point, I'm going to introduce our next speaker for his own presentation. Allow me to introduce to you Victor Alui, Head Portfolio Management, Commercial Partners Asset Management. He's going to have a presentation for about 15 minutes. And after that, I'm going to bring in the rest of the Commercial Partners team to talk in a Q&A session to talk about the markets. We'll be focusing on the markets, risk, of course, opportunities, and of course, really, of course, will continue to give us a macro perspective to the conversation. So Victor, you have the floor.
right, thanks a lot, Esther, and thank you everyone for joining. All right, we just essentially, this session is just to look at, very quick overview of what we think we're likely to see this year and the various risks, that are out there really, this year for 2021. All right, so for the fixed income market last year, I think a number of factors drove things in that market. The market actually started out quite resilient last year, but we had towards the end of 2019 that OMO exclusion that essentially significantly reduced the universe of instruments that participants had access to. And so we saw that impact on the market. And as COVID hit, that impact was also quite significant on the market. But from around May, we saw a significant drop in yields, and that was essentially heralded or anchored by a lot of the liquidity that we saw that came through last year. Estimated around about 13 trillion worth of liquidity came through last year. So all of that acted to force yields downward in the fixed income market. At the short end of the curve, yields were down over 500 basis points. At the long end, they were down just slightly shy of 500 basis points. So we saw a significant compression within that market, and it was on the back of significant amounts of liquidity coming through into the system. But towards the end of the year, through some CBN initiative, particularly around the special OMO bills, we saw immediate reaction that saw rates or yields sort of re-rates upwards towards the end of the year. That scenario is still playing out, and we think that it will continue to have an impact on what we see in 2021. Now, for the equities market, like Dr. Salami had alluded, our market was essentially the best performing last year. But I think a number of key factors that could easily be seen drove the market. We saw that significant drop in yields that made the fixed income space a lot more unattractive, and then this saw funds flow into the equities market. Suffice it to say that sometime around May, when a lot of foreign investors could not repatriate their funds, they were essentially caught and stuck in the market. And then because the whole COVID challenge had brought stocks to multi-year lows, these were very attractive entry points. So we saw the market push up quite significantly from around May up until the end of the year. We saw very strong returns, over 50%. That's the strongest we've seen in close to about 15 years. So that was what we saw in the equities market. The Eurobond market was a very interesting one last year. The market started out on a really positive note at the beginning of the year, but of course, the whole COVID pandemic, particularly across sub-Saharan African Eurobond papers, had a very, very profound impact, particularly with this significant drop in crude oil prices. We saw, yields, particularly for Angola, even Nigeria, Ghana, Kenya as well, hits multi-year highs, and the reflection of as crude oil potentially falling off a cliff. But as OPEC had that meeting where they decided to take a significant amount of output from the market, as lockdowns started to ease, we saw a stellar recovery in crude prices, and we've seen significant compression in yields. If you look at the Angolan curve at the short end, yields are still just slightly shy of the pre-COVID levels. If you look at the Nigerian curve, those yields are right now even below those pre-COVID levels. If you look at Kenya, you look at Ghana at the short end, yields are just slightly shy of those pre-COVID levels, while at the long ends, we're seeing yields already drop below those pre-COVID levels. And we think a lot of interesting things will continue to happen within that sub-Saharan African Eurobond space. We'll speak to where we see the opportunities and what the risks are within that space as we progress in slides. Now, in terms of policy response, I think Dr. Salami had covered that part quite significantly. So we'll just move on to some budget assumptions for 2020, looking at the performance in terms of budgets. These are areas that I think that Dr. Salami has also covered. So we'll just jump right to what our outlook is in terms of the various market, where we see the opportunities, and what the risks are, and in terms of what we see in 2020. Now, for the fixed income markets, I think just like the conversation earlier had alluded to, we think that yields are going to trend upwards. From a liquidity standpoint, like I mentioned earlier, last year we had about 13 trillion worth of liquidity flowing into the market. This year, we have just about 3.5 trillion. So that's a significant reduction. Add on top of that, the expanding fiscal deficits, which essentially would imply that the government is likely to borrow a bit more. So all of that, would certainly act to exert that upward pressure on yields in the fixed income market. Now, for the equities markets, like I alluded to in my earlier comments, the factors that have driven equities have been outside of equities, if you will. And we think that there are prospects, nevertheless, a reversal in the yield conditions in the fixed income put paid on the sort of ascendancy that we have seen in it. I think that as those yields reverse upwards, it would make the fixed income market even more attractive again, and obviously would make participants want to get not be able to get the sort of reward that they will get for whatever risk that they are taking, and that is likely to create a downward trend in the equities market. For fixed income, like I highlighted earlier, that liquidity will continue to play a major part. That drastic reduction in liquidity, the expansion, in the fiscal deficits, we think will play a major part in, exerting that upward pressure on yields. For the Eurobond market, the sub-Saharan African space is essentially an oil play. So obviously, what goes on with crude oil will significantly determine, what happens within that space. Also, the fiscal viability, of those countries will come into play, quite significantly. So for Eurobonds especially, we think that, the possibility of a default contagion is a major risk on the horizon. Over the last couple of months, Zambia has been talking to creditors. Just last week, he missed some coupon payments. We think that, there is the possibility that this could spread and create a negative sentiment across sub-Saharan Africa. Although a lot of the other players like Angola are much, solid footing, they've been able to get some forbearance from their major creditors, also been able to get some sort of IMF funding as well, that we believe would assuage some of the fiscal difficulties that they had faced last year. Nevertheless, I think that risk of default contagion is something to keep an eye on. Crude oil is also extremely important because the direction determines sentiment and direction, for Eurobonds. We still think that there's great value in Angola, like I had highlighted earlier, in terms of that yield movement, particularly at the short end. The Angolan Eurobonds are still shy of their pre-COVID levels. And we think that there are great prospects for those yields to creep back to those pre-COVID levels, because that's what we've seen, across sub-Saharan Africa, for Nigeria, for Ghana, for Kenya, Rwanda as well. So we think that there's still some headroom, for Angolan Eurobonds to reprice and retrace even further downwards. Now, in terms of local equities, like I'd highlighted earlier, I think the major risk there is a key reversal, in the yield trajectory. We think that would make the equities market a lot less attractive to participants. Nevertheless, we think that there are strong, dividend yield plays in the market, which investors have latched onto last year. We think that, those opportunities still exist in the market, particularly within this period where, full year results are going to be released in a matter of weeks, and we'll get those benefit declarations. So I think that investors can, position in the market to get some, decent benefit declaration. Now, part of what we're also looking at is, the foreign equity space, particularly the US markets. For us, we look at it from a thematic perspective, and a number of things we think will do well going into this year. So renewables, clearly from a policy standpoint and from a policy positioning posture, we think that renewables will do well, particularly because it's a key policy agenda for the Biden administration. So companies that operate within that sector, I think, are poised, to do it. We also think that, banks in the US are also positioned to do well. We've seen, an upward retracement of those, US Treasury yields on the 10-year. We've seen those yields move from about 50 basis points right now to just slightly shy of about 1.1%. We think that as those yields retrace upwards, it will provide outcomes for the banks in the US, and we think that they are going to be positioned to benefit quite significantly. Also recall that they had been significantly that's taken a significant beating as a result of the COVID pandemic. So we think that from a valuation standpoint, from a fundamental perspective, and also how things are shaping up with the yield situation in the US would augur well for the banks there. Another major thing that we think would also do well, even as the global economy recovers and things begin to open up even more, is the hospitality sector. And that's just on the back of the fact that they've taken a significant beating, they're probably the hardest hit in terms of the whole COVID pandemic situation. So we think that as things begin to open up, as things begin to recover from a very, very depressed valuation standpoint, we think that there are great, opportunities there, for investors. Now, for the real estate sector, clearly from a local perspective, I think that, the low yield environment had created, great, opportunities within the real estate sector. We've seen a lot of investors piling on there to take advantage of, significantly better returns there. We've also seen, the pandemic in itself, in terms of trends, making, real estate a bit more attractive, so the remote working and also the shortage of, quality residential stock. So a lot of people are having to essentially work from home now. So that demand for quality residential stock continues to rise. So we think that the opportunities within that space, will continue to grow. Some of the risks, however, within that space, the FX, situation, FX vulnerability remains a key risk, taking into consideration the fact that a significant amount of inputs, particularly finishing inputs, have to be imported. So that risk, is still significant and still continues to stare us down the barrel. There's also that time lag in terms of construction and delivery of projects. So clearly, in certain instances, we have projects that are drawn out and delivered, not necessarily to time and not necessarily to budget. So that's another key risk that we see. Also, we're seeing, a significant drop in footfall for, residential malls and even the bigger malls because of the whole COVID situation. So these are risks that we see, within the real estate sector. Nevertheless, we think that there are great opportunities there, particularly within the residential sector, as a result of the trends that we're seeing with COVID. So all in all, from the local equity side, we think that there are, decent opportunities for, strong benefit declaration that we're likely to see over the next couple of weeks. However, if we will continue to see an upward retracement in yields, this is likely to put a lead in terms of the upside potential for the equities market. For fixed income, given the sort of significant reduction in liquidity that we're seeing, the expansion in the fiscal deficits, the inflationary pressures, we think that those yields are going to have an upward pressure. For Euro bonds, we think that the global monetary stimulus will continue to support that search for yields. There's essentially a wall of money out there, looking for decent dollar return. We think that will continue to support the SSA Eurobond space. However, crude oil prices, a default contagion remain significant risks in that asset class. So we think that 2021, there are significant opportunities, but there are also potential headwinds that we need to keep our eye out for to ensure that we're able to profitably follow the money in 2021. So that's pretty much it in terms of our outlook. We'll be happy to speak to questions even more broadly, from the presentation. Thank you very much. Over to you, Esther.
Thank you very much, Victor, for that very robust and insightful presentation. We have a couple of questions that have come in from our respondents, but I'd like to kick things off with a question from myself. I'd like to take you up on the equities markets. Now, as we all know, Nigeria's stock index was the best performing for 2020, and the market is already off to a good start this year. Now, although the market is in a bullish run, many of the top investor favorites, particularly the banks, are still operating in a weak macro, and for the banks also, there are still asset quality concerns. I'm just wondering, and of course, add to that is a shrinking consumer wallet, and this speaks to the consumer goods players at the market. How do you see investors balancing the act of cherry picking and ensuring that they cherry pick where they will get the best returns?
Right, thank you very much, Esther, for that. I think that, like I highlighted earlier, so the move that we saw in equities last year wasn't necessarily a reflection of, the macro story. Typically for equities, performance there is usually tied to what's going on with the macro situation. So what we saw had absolutely, for me, no bearing on the macro situation. It was what you would describe essentially as a hunt for yield. So basically the yield in an alternative market had essentially fallen off a cliff. So you saw investors pretty much moving money into this market to, look for yields, basically. So in terms of the macro situation, I think that it will continue to, weigh on sentiments, particularly once we see, the yields in the fixed income market start to inch up and continue to do that in a sustainable manner. I think that investors will begin to rethink the risk reward that they're looking to get. So safety becomes a key issue here. So I think that the macro situation will continue to weigh. However, I think that as that situation also improves, like Dr. Salami alluded, and just like we had in the conversation in the previous session, we're likely to see a recovery in the economy sometime maybe towards the end of the second half or in Q3. That could bode well for the equities market. But for the banks, again, they've operated in a regulatory environment that has not been exactly friendly over the last couple of years, although a lot of them have shown great resilience. But I think that the broad macro issues will continue to weigh on investor sentiment, particularly as these yields begin to tick up in the fixed income market.
Okay, thank you, Victor. Now I'm going to bring in the rest of the Commercial Partners team, starting with Tosin. Tosin, still on the fixed income market, if we do see yields trending higher, do you think that as the government tries to obviously borrow more this year to fund the budget deficit, do you see the yields being high enough to attract and regain and perhaps keep those investors back at the fixed income market? And but more importantly, where do you see the yield curve beyond Q1 2021?
Thank you, Esther. I think for us, our views are largely driven by the level of debt service. Okay, so you would agree with me that the debt service level is a major concern to federal government, it's a major concern to central bank, and it's a major concern to the debt management office. We believe that yes, there might be a reversal this year, but there will be a moderation of interest rates. We believe that even as maturities of automobiles begin to wane, because what you have in 2021 is not as much as what we had in 2020. That begins to play a major role in the level of liquidity in the market. I expect that we might not see a double digit this year, in spite of the fact that inflation is shy of 16%. Again, we need to look at what drives the MPC decision. Obviously, for them, they're looking at, more importantly, how to stimulate the growth of the economy as opposed to managing the inflation rate. if for any reason during the year they decide to turn around the ship, all right, to address inflation, then we might see, tightening of monetary stance. And when that happens, we begin to see those yields, reversing. But by and large, we don't see it reversing to double digits. We might see events that could give rise to spike in double digits, maybe early 10s or 11s. But if that happens, I think it's just going to be a knee-jerk reaction because there's too many moving parts, this year. I would expect that just like every other central banks and countries or economies are moving to stimulate, their countries and economies by accommodative, monetary stance. I believe that Nigeria will certainly not be left out. The central bank has demonstrated, that their core focus right now is to stimulate the economy as opposed to managing inflation. So for us, we believe that yes, we would see moderate interest rate. We don't believe that we would see, double digits in the first half. If there's going to be any rise to double digits, it's probably going to be in the third or the fourth quarter.
Thank you very much, Tosin. Now, Steve, let me bring you in. We know that investors are, there's currently a dividend yield play at the moment. Not surprising, but I'd like to quickly hear your thoughts on the earnings outlook for banks this year. As I mentioned earlier, it's a weak macro environment, not just for the banks, for companies this year. But what is your projection? Last year we saw historically low yields and non-interest income for these lenders did drop. But what is your projection this year as the banks try to recover or boost their earnings?
Thank you, Esther. I think the story is actually been touched by Victor when he was making the presentation, which is one of those cautious things we need to look out for in 2021. And one of the reasons why we actually organized this seminar or this conference, so that at least we can actually educate our clients and our investors on the risk involved and the opportunities that we have in 2021. I think banks, if you look at how they played out since the beginning of last year, 2020, when some of the stocks actually were, were sold off before we now started having a recovery, when we saw quite a lot of, opening up of the economy towards the second quarter of last year. And at the same time, we saw the low interest rate regime, which was at a point, is the milk house for a lot of banks. When the interest rates on government securities were like double digit. But last year we saw the interest rates on 1-year paper as low as 0.5% and 1%, which significantly actually reduced the margin they usually have in that sector. But at the same time, I think it provided them another opportunity for them to be able to raise cheap deposits, because towards the end of last year we discovered that a lot of banks actually were taking money at 0%. 0.1%. So if you look at that vis-a-vis the extension or the growth you've seen in terms of their loan to deposit ratio, which has moved from around about 3 trillion when the policy was just revised by the central bank to about gross credit that we have right now as at the end of January. Sorry, at the end of January, I think it's about 20 trillion, gross credit in the system. So I think that will have provided them a bit of cushioning in terms of margin or earning. But that being said, from the first numbers we've seen, audited account results I've seen from few banks, I think a lot of their earnings have actually compressed slightly, even though they're still making a lot of profits. And I think that's going to play out in the minds of investors and how they're going to, cherry pick the stock. They think that's going to give them dividend, yield returns that they have. And at the same time, even when it's marked down, there's a possibility for a potential growth in terms of acquisition or the upside, opportunity for some of those stocks. So I think by and large, we're going to see a lot of opportunities here and there, but at the same time, we're going to be very cautious in terms of how to invest in some of those stocks. And I think the bank's stock will probably remain relatively subdued at this level, and slight interest coming from investors up until when we'll see maybe a slight shift in yield uptick this year. Thank you.
All right, Nnamdi, let me bring you in. for those investors who are saying to themselves, okay, I want to be a part, the equities market is looking up. I want to be a part of this market. Where do I begin as perhaps a new investor? Where do I mean, I hear terms like cherry picking. I hear terms like positioning. I hear terms like dividend yield, positioning ahead of earnings. For those investors out there who are perhaps participants at today's webinar, what is your advice to them? Hello, Nam, did you hear me? Okay, perhaps Victor can answer that question.
All right, thanks, Esther. I mean, I think that it's all boils down significantly, particularly for someone who's just starting out, to what your investment objectives are. It's also important to understand what your risk appetite is, and then the sort of risk that you're going into. Like we've highlighted, or like I highlighted in my presentation, there are headwinds or risk elements to look out for.
Thanks for the question. Well, if you're basically new with more,
looks like we have Nnamdi.
Yes, I can. Can you hear me?
All right. Okay, go ahead, Victor. Sorry about that.
Hello.
Nnamdi, go ahead.
Okay, go ahead, Nnamdi.
Okay, sorry. So I was going to say that if you're new to the market, then what I was going to say is that the first thing you need to do is to sit down and have a who can advise you on the way forward. People tend to look at penny stock rather than looking at where you have true value, right, in the stock market. So my advice would be, first of all, look at where we see, by the time you sit down with your advisor, they should be able to point out to you where they see value right now in the market. So you have to look at things like government policies and what is government trying to promote. So, or what's happening currently in the economy. If, for instance, you have someone who is in the pharmaceutical sector producing face masks, just think about the volume of face masks that people are wearing on a daily basis, as an example, right? Or if you're looking to the real estate sector, you're looking to the banking sector. In every single sector, you have the where one needs to look at investing. So the advice would be, first of all, to sit down with people who are more experienced. For instance, you can call it our own universe of stock that we look at, and we believe, you know what, come in, sit down with us, and we would advise you and put you to look at where we see the best value in the market as at today, and where stuff that we think are going to perform very well this year, right, and into the future. And then we can now try and model or create a portfolio for you around that, rather than have you just shooting blindly and just picking stock without having done proper analysis of that.
All right, thank you very much, Nnamdi. Abiola, let me bring you in here. There's a question from one of our respondents, Philip, and he's asking, can you provide more insight on the underlying objectives of the CBN special bills? I believe that the one that was released, issued last year, and how realistic it has been in setting, in achieving its set objectives?
I would say to a large extent, it not has been as effective as they would have liked it to be. Obviously, I think that there is a chance that you know, as we enter into 2021, we may see that happen. I think yes, I think that's what I believe. I think maybe the question may be best answered by you know, Tosi or someone else.
Sorry, can I take that question, Esther? Sorry.
Sure. Go ahead.
Okay, thank you, Abiola, for your contribution there. I think, so if you look at the number that was actually issued in 2020, the special bill, I think was about 4.1 trillion. So at that point in time, just from the analysis we've done, we've analyzed the amount of liquidity that actually was in the system, which came through via OMO at that point in time, and how the liquidity glut is actually causing a lot of inflationary pressure at that point in time. So, but it depends on how you look at the reason why they issued that particular bill. At the point, it looked like central bank was just trying to mop up the excess liquidity from the system. But again, on the flip side, if you look at some of the informations or the discussion that actually went behind, and it was more like, a lot of banks were struggling with meeting up their liquidity ratio. And so as such, a bill with an elevated yield compared to what you have in the primary market of the 1-year bill would actually be issued to them. But that being said, I think if you look at the liquidity, amount of liquidity that was mopped from the system that time, so you say yes, maybe it met to some extent the level or the reason why it was issued. But if you look at the knee-jerk reaction that followed thereafter, because to some extent, it looked like more that central bank was trying to raise interest rate, and that actually affected, the yield in the interbank market, and which we saw slight jump on the federal government curve, and most of the corporate bond or issues that actually came within that particular time. So, but I think at the long run, it's just more at CBN trying to minimize costs, because for some of those bills that were issued, especially the OMO bill, you notice that they were issued at relatively around 5 to 7% at that point in time, where the special bill was actually issued around 0.5 at that point in time. So by and large, in terms of cost management, maybe it helped them, and in terms of liquidity management, at the same time, it helped them. Then if you look at the other reason, which was actually postulated from the bank side, so it met that particular reason. So thank you.
Thank you very much, Steve. Let me bring Relay in here for a fiscal perspective. Now, Relay, I know that, we know that the government is trying to, or has been trying to make the business environment a lot more friendly and a lot easier for businesses. And more than ever this year, perhaps will be a test of how those policies translate to a better and friendly business environment for businesses, particularly small businesses in the country. Now, the passage of the Finance Bill 2020 has been said to be a game changer for the performance of annual budgets if adequately and effectively implemented on an annual basis. So what positive outcomes are you expecting as we go forward?
I'm not sure that, that's a very elaborate question that I'm not sure that I can do justice to, but I think the point is, in fairness to this administration, improving the business environment has been a focus and something that a lot of effort has been made to attempt to address. So however sort of harshly we want to evaluate those interventions, I think it's no doubt fair to say that we are not where we were. If nothing else, just from the consciousness and the awareness level and the fact that it's now front and center of conversation is an improvement on where we were previously. In terms of the budget, I'm not really of the view that having a big budget in and of itself, or the budget just going up, is a source of comfort. There was a comment made, I think, in the previous session about if Nigeria is going to achieve certain things from an economic development and growth point of view, that it can't be done unless budgeting, the budget is higher than it has been in the past. That's only really a meaningful statement if we are better at allocating, if we're better at implementing. I don't know off the top of my head what the budget performance figure was for last year, but even when we achieve north of 70% budget performance, it doesn't necessarily mean that that the expenditure was effective. So as I keep reiterating, on this call during this conversation, we have to look at multiple variables and basically hold accountable on multiple variables, because what we tend to do is we tend to look at, okay, the budget is X what size. We're looking like we're going to see a flood of government spending that's going to go through the economy and move the needle, and maybe we don't look at how it's going to be financed, and we don't look at performance. So I think that what I want to see in terms of budgeting, what I think is going to make the difference is I wouldn't mind a smaller budget, but I budget that is more transparent. We talk about zero-based budgeting, but I'm not really sure whether we do it. I think the budget is a very political document, both at the federal and the state levels. So, and then without the transparency to actually effectively monitor how it's been implemented, it can quickly become significantly less meaningful than it should be. So I think that, being able, for private sector operators, being able to place a demand, however this is done, maybe this is on account of coming together, maybe it's on account of advocacy, and in groups pressing in for greater responsiveness from governments at the state and the federal level, to actually have real data, not just headlines, not just sound bites, but actually real data on what is being spent, how it's being spent, and what the outcomes are. Without those things, many of the things that we can be fixated on don't matter as much as we would like to think.
Now, really, if I go to the next speaker, I want to ask you a question, and I need you to answer in just 10 seconds. Would you say that Nigeria's annual budgetary approach is defective, and we need to adopt a more resilient approach that suits the country's economic peculiarities?
Yes, I can do that in 1 second. Yes.
Oh, okay then. Thank you. Let me move on to Tosin. Tosin, now obviously investors they're keeping their eye on this equities market, and of course the key question will be how they're balancing risk and reward. For you, perhaps on a sectoral basis, what's on your radar? What can you say to investors or potential investors?
All right, thank you, Esther. I think on our radar, it's not just the equities, market. On our radar, we also have the Eurobond space. I think that the 50%, performance last year, we might not see that this year. Obviously, the 50% was likely driven by the level of liquidity and the fact that the low yield environment in the fixed income market. That is beginning to wane. Obviously, year to date, we've seen decent performance, but I don't think it's sustainable. I think a lot of people actually in the equities market, they are waiting for last year results, which should come out in Q1. Obviously, should start coming out. Some of them have started coming out. And we expect a lot more to come out in February and in March. We think that we might see some, bearish sentiment come in April, and people might begin to look out for other, traditional asset classes. So a lot of people have actually positioned, a lot of investors are positioned for the earnings. So once they're able to benefit from those earnings, we might see some bearish sentiment coming into the market. For us, we're looking at an expanded asset classes outside of, the equities market. Like Victor rightly alluded to, we are looking at the US equities market. We believe that it's a market that a lot of Nigerians should begin to look at. We've been advising, over the years or over the last 2 years that local investors should look at diversifying their portfolio from narrow investments to have a bit of, US dollar investments as well. So for us, we are big in the US market space. We are big in dollar-denominated asset classes. Eurobond, for instance, has been one area that a lot of us benefited from last year. Last year performance in the Eurobond space was very fantastic. There were super profits that were made in the space between Angola bond, Rwanda, Kenyan bond, Ghanaian bond, and Nigerian bond, of course. Some of those instruments were trading at 40 cents to $1, 50 cents to $1. And right now they're trading at $1 or even above, their par value. We don't see that, huge performance or super profit playing out in 2021, but some of them are still, away from their pre-COVID level. So you'd expect that there's still some value in that space. And before COVID, we didn't have the level of funds in the market right now. So we've seen significant, stimulus package the US market is still, debating to release another, tranche of stimulus, which we expect should come into the market. So you can imagine now that we have significant amounts of stimulus package, most of those funds will find their ways into financial instruments. And some of those funds will come into the same market. So going forward into 2021, we would always advise our clients to have a diversified, portfolio. Yeah, you could have a bit of local equities, you have a bit of US equities, you have a bit of Eurobond, a bit of, real estate as well. Because it's important that you have all of these in the case that in the event that there's a shock in any one of those, in any of those instruments, you're well diversified and you have a balanced portfolio. Thank you.
Thank you very much, Tosin. Victor, let me bring you in here. Tosin has said a lot, and I think that he may have sparked some extra interest from investors talking about the opportunity to actually have that kind of basket, a wider range of investment options. But I mean, what kind of level of risk appetite is required to have that when you talk about these international markets? We know that there is still the volatility risk aspect of it. But for an investor who is watching and wondering, okay, how do I get in there? What level of risk? If I'm a conservative investor, do I have a piece of the pie?
So I think you have to look at it strategically. For us, it's not just the returns or the opportunities that are there. Again, because of the nature of our economy and a lot of the external imbalances and vulnerabilities like Dr. Salami had highlighted in his presentation, continue to present a situation where the Naira is perennially weak. So as an investor, how do you hedge your wealth? How do you ensure that easiest things, of course, you want to do is to convert some of your wealth into dollars. But over the years, we've seen situations where the question is not about converting some of your wealth into dollars. The question is around what sort of outlets you want to put those dollar investments in that will give you decent, safe returns over a period of time. And that's the reason we talk about those Eurobond investments. That's the reason we talk about, the US equity markets. For us, a lot of the policy initiatives, particularly from a monetary standpoint, would continue to support, the US equities market. And that's the reason, we talk about that. So from a strategic point of view, this essentially starts as an investment strategy aimed at hedging your wealth against that perennial, erosion in the value of the Naira, really.
Okay, our time is fast spent. I think we have just a few minutes. Well, we actually have a few minutes left, but I want to quickly get a final thoughts from Abiola. Abiola, I think Victor touched on this earlier, but I'd like to hear your thoughts on the corporate debt market this year. We saw corporates issuing commercial papers last year, of course, with the yields lower at that time. So I'm just wondering, what is your outlook for that this year?
Okay, so just to quickly clarify, Esther has been asking me fixed income questions. I am not a fixed income expert. I am an equities expert, and I have knowledge of the overall investment market. So if you find that my answers in fixed income are not as strong, it's because I'm not an expert in it. So I really need to apologize for that.
No, I am the one who should apologize for that. Sorry. It looks like I have a stronger interest in the fixed income market.
I know you're trying to make me an expert in it, but that's not what I'm good at. So I need to stick with what I'm very good at. The CP market, absolutely. There were quite a lot of issues last year. It was a low interest environment. And so a lot of the corporates took that opportunity to invest in it. And I think that, again, going into 2021, it would obviously be a function of what their needs and what their requirements are. And if we, and this is probably the environment where they should probably invest a bit more, given that interest rates are low. So possibly there could be more, corporate yield and corporate issuances this year. And just to touch on something that Victor had mentioned too, in terms of what the outlook, where opportunities lie for investors. I think an area where, I think he touched on it briefly, but I'm not sure, is actually cryptocurrency. I think they're definitely a bit more focused on that. We've seen that move about 30% this year. I think that's definitely been more attractive. I think that would, we've seen a lot of Nigerians latch onto that space as well as the US market space. And I think that trend will continue to happen. In the Nigerian space, while the equities market, we think that the performance will likely be around 10-20%. I do think that a lot of what's going to keep that market as vibrant as it is would be the participation of mass affluent investors. And I think that we'll definitely see some of that going into 2021. Though, though the expectation is that interest rates will be higher, I do think that the pension funds, given that their holdings in equities is about 6%, it's likely, we're likely to see that remain stable, and they may actually sort of increase the exposure in the equities market, even though interest rates would likely go up. So we think that by and large, the equities market will relatively stay stable in 2021.
Thank you very much, Abiola. Very interesting point you mentioned there with the cryptocurrency, but I know if I go into that, we are going to spend like 1 hour talking about that. So I'll just leave cryptocurrency out for now. So let's take, I'd like to take just final thoughts from our speakers. 10 seconds each from everyone as we close this session. We have more questions from our participants, but I'm afraid we may not be able to take any more. But we thank you for sending in your questions. We had some of them answered, but of course you can always reach out to the Commercial Partners team to answer those questions for you. So Nnamdi, closing thoughts from you for the markets. What is your special interest? What are you looking out for? 10 seconds, please. Perhaps Tosin, maybe you can go first.
All right, thank you, Esther. All right, I'll say to everybody and to the audience that if you lost money last year, you don't want to lose money this year. In addition to you staying alive, you want to be sure that yes, you have enough money to keep your well-being intact. So you need to meet with professionals to ensure that yes, you can weather the storm this year. Thank you.
Absolutely.
Quick one, I'd like to see how interest rates play out for this year. I'm interested to see how central bank. I'm interested to see how the interest rate market plays out here, and very interested to see how that plays out. And also the Euro bonds market went, we had extremely high yields last year. I would love to see how that market plays out. So my interest mainly around how market
Nnamdi, at this point, perhaps we could just quickly move on to Victor. We're having challenges making out what you're saying. Perhaps we could just quickly move on to Victor. I'll circle back to you.
All right. I'll say that, for solid investment advice, you want to reach out to us. Thank you.
All right, let's take closing statements from, okay, well, Rele, I still see Rele here smiling. Okay, well, Rele, we've taken final thoughts from you, but thank you for sticking around. I'll quickly hand this over to Steve Osho for his closing comments.
Thank you, Esther. Even though you didn't ask me for my own closing comments.
It's a two-in-one closing statement.
Yeah, so let me do that quickly. So for me, a bit of good statistics that I've actually come across lately. So if you look at most of the advanced economy, talking about UK, you're talking about US, talking about Japan, and India, and Korea. If you look at the amount of stimulus package that have been pumped to the system, they are in double digits if you look at it compared to the size of their GDP. And if you look at what Nigeria has done so far, I think what we've done is about 2 trillion, which is roughly maybe about 3% or 3.5% of our GDP. And in terms of the central bank, continuing the policy on the expansionary and accommodative policy, I think it's going to be very important to how they look at it strategically into achieving this strategy into 2021. I know there's a bit of concern around the inflation rate and inflationary pressure, but at the same time, we need productivity, we need the economy to move, and we need people to actually, spend a bit of money and invest. So as asset management company or a financial advisory company, we know we need to advise our clients on where to put their money, but at the same time, we need to reflate the economy in a particular way that we know that is going to be comfortable and conducive for investment in Nigeria. Thank you. So I think let me take my final closing remark. we've come to the end of an insightful and highly informative event, I believe. I'm very grateful to all our speakers, particularly our distinguished keynote speaker, Dr. Doyin Salami, for the interesting presentation he did earlier. I'm sure most of those points that he raised will become so topical to policy makers, and investors and stakeholders in governments going forward. And I want to say very big thank you to our knowledgeable, adept, competent, eloquent, and smart panelists, Ms. Rele Adeshino and Ms. Abiola, for their wonderful insights and contributions to making the webinar session a wonderful experience for all. And I also say thank you to you, moderator Esther Awuni, for the professional way you handled and conducted the session by making it very interactive for everyone. Furthermore, my thanks to all our dedicated staff who have labored behind the scenes to make the virtual convening a success. We give you kudos for all the good work you've done. I also appreciate everyone who took out time to join us on this call. We did not take your time with us for granted. We say thank you and thank you so much. People might wonder why the knowledge series. Interestingly, this is the third edition of our knowledge series. Less possibility of knowledge sharing to achieve that. And if you look at this event, you've seen that you've done a lot of collaboration with people because we've been collaboration with people. Lateral spirit of partnership is intact. And webinar session or the team title 2021 Outlook, the money, the market, and the risk. And to all our clients and to the prospects, we believe you've been informed to understand the dynamics of the market and to know how to follow the money. So you know where the money is going now and you can follow it. And as well, identify the risks that are involved or inherent in this market. And we believe that together we can journey through the financial market in 2021. Thank you very much for your time and have a good day.
Thank you very much, Steve. With that, we've come to the end of this webinar hosted by Comercio Partners. As I said earlier, you can reach out to the team. This year is not just about investing as I think it was Victor that alluded to that area. It's not just about investing in the Nigerian capital market. There are other opportunities outside of the Nigerian capital market. And of course, this team can guide you through all of that. I think that, of course, the knowledge series continues. Thank you all so much for your time today. And we hope that when we call you again next time, you honor our invitation. I've had an amazing time anchoring this session. And I've also, even though I'm a business anchor, I've also learned a lot myself today from the team and of course from our special guests today. Thank you so much to our special guests. I suppose is bye-bye for now. Thank you all. Have a good rest of the week and of course a good weekend. Bye-bye.
Bye-bye.
Bye.
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 Thank you all.
Thank you.